Usually when we think about physical assets,
Right, like real estate.
exactly, specifically real estate, we picture something akin to like a bank vault. It feels solid. It feels, entirely stationary.
Right. You put your money into a property, you lock the door, and the assumption is just that it sits there.
Right.
Yeah.
Safely holding its value until you decide to open it back up and sell.
Yeah, it's a very comforting illusion, to be honest. I mean, we are totally conditioned to view bricks and mortar as the ultimate permanent investment.
But then you look closer at the actual mechanics of property ownership, and suddenly that bank vault starts looking a lot more like an hourglass.
Ooh, I like that, an hourglass.
Right, where every single grain of sand dropping is a little bit of value being actively eaten away by time, by the weather, and, well, by market friction.
Definitely.
And that is exactly what we are getting into today. Welcome to today's deep dive. Our mission for this conversation is to extract the hidden mechanics of property valuation and asset liquidity.
Yeah, and we're looking at this through the lens of a highly dynamic, really high-stakes ecosystem.
Sarasota, Florida.
Right. The Sarasota micromarket is a brilliant case study
Right.
because whether you are managing, say, a historic downtown bungalow or, looking at a modern eastern suburb home,
Right.
understanding the specific environmental and economic pressures of your micromarket is crucial to preserving your capital.
Absolutely. So our source material guiding us today is this deeply technical industry article from April 15th, 2026.
Yep.
It was published by a specialized acquisitions firm called Sarasota Sell House Fast Buyer, and it's titled Maximizing the Value and Liquidity of Residential Properties in Sarasota, FL.
Catchy title.
Very to the point, right?
Yeah.
Now, while this is focused on Florida real estate, it is honestly a masterclass in how to look at the liquidity of any physical asset.
Oh, for sure.
It reveals the hidden friction dragging down the traditional real estate market, why time is literally money, and how this sort of shadow market of specialized buyers operates outside the standard retail channels.
And honestly, if you don't grasp the underlying mechanisms detailed in this kind of material, you just leave yourself entirely vulnerable.
Yeah, because you assume the traditional market will always be there to bail you out.
Exactly. Ignoring the unpredictability of buyer financing and those, agonizingly long retail timelines.
Okay, let's unpack this because we really have to start with the physical reality of the region itself.
Environment.
Yes. You literally cannot understand the real estate market in a place like Sarasota without understanding the environment that is just relentlessly attacking these physical assets. We aren't just talking about a rainy day here.
Oh, far from it. The Gulf Coast environment dictates absolutely everything about the functional life cycle of a home.
Right.
You're dealing with a relentless combination of high seasonal humidity, intense ultraviolet exposure, and, of course, the ever-present threat of tropical storms.
Which is terrifying.
It is. This environment is actively breaking down building materials on a molecular level.
So let's talk about the mechanics of that wear and tear, because the source highlights how drastically this impacts things like roofing and HVAC systems.
Right, think about the roofing membranes, for example. The intense UV rays down in Florida, they don't just heat the roof. They actively bake the essential polymers in the roofing materials.
Wow, literally baking them.
Exactly. And over time, those polymers dry out, the shingles or membranes become incredibly brittle, and they lose their ability to expand and contract.
And then a storm hits.
Right. You introduce severe wind from a tropical system, and those brittle materials just snap. And underneath all of that, you have the HVAC systems working overtime.
Because of the humidity.
Yeah, when an air conditioner is fighting severe, near-constant humidity, it's pulling massive amounts of moisture out of the air.
Oh, that makes sense.
If the drainage line clogs even slightly or the insulation isn't perfect, that moisture gets trapped inside the walls.
Which is a disaster.
It's the perfect recipe for aggressive mold growth.
And the text specifically mentions plumbing infrastructure, too, which I found fascinating.
Yeah.
Because you don't really think about the weather affecting pipes buried in the ground.
Well, it does when you factor in the specific soil composition and the historical building materials of the area.
Right, the cast iron?
Yeah, many older homes in the region were built using cast iron plumbing. When you bury cast iron in sandy, moisture-rich Florida soil, a chemical reaction occurs.
It just rusts.
It literally oxidizes and rusts from the inside out over decades. Eventually, the bottom of the pipe just rots away completely.
Oh, man.
And replacing that requires trenching through the concrete foundation of the house.
Which sounds expensive.
It's a financially catastrophic project for an average homeowner.
So because that Gulf Coast weather is constantly degrading the asset in these hidden ways, The seller is basically on a ticking clock.
Exactly.
And this brings up a brilliant point from the text, the seasonality paradox.
This is such a fascinating dynamic.
Right. The article notes that Florida housing inventory fluctuates heavily based on seasonal migration, like the snowbirds coming down.
Yep, the winter rush.
But the weather actually masks or exposes a home's problems depending on when you try to sell it, like high-demand winter periods when the weather is mild.
Everyone wants to escape the snow up north.
Exactly. That weather often masks underlying structural issues. The air conditioning isn't straining, the humidity is lower, buyers are just enthusiastic.
They're just happy to be warm.
Right. But if you try to sell in the slow summer months, the environment exposes every minor flaw to highly critical buyers.
Which totally makes sense because when a house is sweating in the July heat, any flaw in that HVAC system or that attic insulation is going to be glaringly obvious the second a buyer walks through the front door.
Oh, for sure.
And, well, if we connect this to the bigger picture,
Yeah.
it raises an important question about deferred maintenance.
How so?
Because local labor and material costs in Sarasota have shifted dramatically upward. Trying to execute extensive renovations to fix these environmental damages before selling has become a massive financial risk.
Right. The math doesn't always work out anymore.
Exactly. You have to look at the numbers objectively. Like, will pouring $50,000 into a new roof and new cast iron plumbing actually yield a positive return on the retail market?
Or is liquidating the asset exactly as it sits just a more logical preservation of your remaining equity?
Precisely.
That is a tough reality check for someone who just wants to slap on a fresh coat of paint and, put a for sale sign in the yard.
It's a very different market now.
It really is, but it perfectly highlights the tension here. If the environment is destroying the asset, how does it still have so much value?
Well, that's where location comes in.
Right. The text moves into how location and specific architecture create massive premiums despite those environmental risks.
Yeah, the geography evaluation is shifting, but water remains king.
Always. The text points out that proximity to coastal waterways is the primary value driver, specifically highlighting the premium on homes located west of the Tamiami Trail.
The west of the trail premium is very real.
But it also notes a trend where inland communities are appreciating rapidly due to new commercial developments and, heavily improved infrastructure.
Right, the whole area is growing.
But geography is only half the battle. The choice of architectural styles down there is wild. I mean, it's honestly like choosing between buying a classic vintage sports car or a brand new armored vehicle.
That's a great analogy. And both have entirely different profiles of risk and reward for a buyer.
Right. You have these gorgeous mid-century modern homes. They appeal to a demographic that is willing to pay top dollar for aesthetic authenticity. They want that vintage sports car vibe.
Absolutely.
But as the text notes, they will only pay that premium provided to the engine, so the plumbing and electrical systems we just talked about are fully updated to modern codes.
Right. If it still has the original cast iron pipes, that premium vanishes overnight.
It's gone.
And to add to that, on the other end of the spectrum, you have the armored vehicles. These are the newer constructions built to the absolute latest hurricane mitigation standards.
Which means they have the impact-resistant windows, the specialized roof-to-wall metal tie-downs, the elevated foundations.
Yes, all of it. They might lack the historical charm of a 1950s bungalow, but they offer something much more valuable to a specific subset of buyers.
Which is?
Massive insurance benefits. They attract heavily risk-averse buyers who are staring down the barrel of soaring property insurance premiums across the state.
Oh, that makes total sense.
Yeah, a newly constructed home built to current mitigation codes might cost a fraction to insure compared to an older, unrenovated property, which profoundly impacts the buyer's monthly carrying costs.
Okay, here's where it gets really interesting. Because knowing where the value is and what kind of households value is great.
Right.
But we need to understand how different types of properties are actually evaluated and sold, because a standard house is not a multifamily apartment.
Not at all.
And the metrics they use to appraise them couldn't be more different.
It essentially comes down to the difference between comparative emotion and pure commercial economics.
Emotion versus economics. Okay.
Right. Standard single-family residential properties are appraised primarily on utility and emotion. An appraiser uses the sales comparison approach.
So they're looking at comps.
Exactly. They're looking at curb appeal, the quality of the school district zoning, the modernness of the kitchen. They find 3 other similar houses within a 1-mile radius that sold recently.
And they base your home's value on those emotional, localized purchases?
Exactly.
Okay, so it's highly subjective based on what your neighbors managed to get for their houses. But if I'm selling an apartment building,
The financial metrics change completely.
yeah,
If you're analyzing a multifamily apartment complex, curb appeal is secondary.
right.
You are analyzing capitalization rates or cap rates.
Wait, for those who might not spend their weekends investing in commercial real estate, a cap rate is basically just the pure yield a property generates in a year compared to its price, right?
Yep, it's pure math, no emotion.
That is exactly the distinction. You take the net operating income, so the total rent collected minus the operating expenses, and divide it by the property's current market value.
Okay.
It gives you a percentage yield. Commercial buyers don't care about the emotional charm of the building. They care about the stability of the tenant occupancy, the maintenance schedules, and that cap rate percentage.
So if a seller tries to misprice an apartment building using those emotional single-family metrics,
They are going to severely mismanage their exit strategy because commercial buyers will simply reject the math.
makes sense. And then there is the anomaly of the housing market, which is fascinating in this source. Mobile homes.
Oh yeah, mobile homes are a whole different beast.
Alternative housing is a vital part of the Sarasota ecosystem for affordability. But the source stresses that selling a mobile home is completely different from a standard real estate deed conveyance.
It requires navigating an entirely different set of legal parameters. It really does. You have to navigate specific park regulations, you have lot rent variables, and, which is just a bizarre legal quirk, you are literally transferring a vehicle title in many cases.
That trips so many people up.
Right. Because from the government's perspective, if that mobile home isn't permanently affixed to land you own, you aren't selling real estate. You're essentially selling a parked vehicle.
You go through the Department of Motor Vehicles, not the county property appraiser.
That is wild.
And the legal distinction the source makes there is critical for liquidity.
Yeah.
You have to know the difference between a land-owned manufactured home, where you actually own the dirt underneath it,
Right.
versus a leased lot mobile home where you only own the structure and pay monthly rent for the ground it sits on.
And conventional lenders hate that. Right.
They absolutely hate leased lot mobile homes because there is no underlying dirt to use as collateral if the buyer defaults. Therefore, cash purchasers who specialize in these niche acquisitions are often the only viable exit strategy for a seller because conventional bank financing is incredibly strict, if not entirely prohibitive.
Which perfectly sets up the data table provided in the source, because those financing restrictions dictate the actual timelines of selling.
The timelines are eye-opening.
They really are. The article contrasts how long it takes to sell these different asset classes through a conventional retail market, meaning listing it with an agent on the MLS, versus an as-is cash sale to a specialized firm. The contrast is staggering.
Let's look at the mechanics of those delays.
Okay, for a standard single-family home, the conventional retail closing timeline is 45 to 60 days, but an as-is cash sale is 7 to 14 days.
And that 45 to 60 days for retail is assuming everything goes perfectly.
Which it never does.
Right. It assumes the buyer's mortgage underwriter doesn't find an anomaly in their credit history on day 40, or a home inspector doesn't find a minor roof leak that derails the entire negotiation.
Exactly, and look at tiny houses and condos. The source lists them at 45 to 60 days for retail, but only 10 to 14 days for cash. Why does a condo take 2 months to sell?
Because of the heavy bureaucracy of homeowner associations.
Ah, HOAs.
Yeah, when a retail buyer gets a mortgage for a condo, the bank isn't just underwriting the buyer, they are underwriting the entire condo association.
I never thought of that.
The bank demands to review the HOA's master insurance policy, their financial reserve studies, their litigation history. If the HOA doesn't have enough money in their reserve fund to replace the community roof in 10 years, the bank will deny the buyer's loan entirely.
Just straight up deny it?
Yep. Furthermore, many HOAs have a mandatory right of first refusal period, or require board interviews for new buyers, which artificially forces the timeline to stretch to 60 days.
While a cash buyer bypasses almost all of that secondary bank underwriting.
Exactly.
And for those manufactured homes on leased lots we just discussed, 30 to 60 days retail, down to a blistering 7 to 10 days for a cash sale.
That speed is crucial.
Which leads us directly into the real threat here. Because waiting 60 days on the open market isn't just an annoyance. For some sellers, it can be mathematically devastating.
You really can.
The article talks deeply about the distress factor. Life happens. Medical emergencies, sudden job loss, unexpected out-of-state relocations for work. These events demand immediate liquidity.
Right.
And if you have property taxes piling up or monthly mortgage payments falling behind, the threat of bank intervention and pre-foreclosure is very real.
Very real and very fast.
The traditional retail market is simply too slow and bureaucratic to save a seller in that precarious situation.
It forces the seller to act proactively to protect their accumulated equity before the bank initiates foreclosure proceedings, which, I mean, would destroy their credit rating for a decade.
Oh, wait, I have to push back here because this is where a lot of people get skeptical. I hear what you're saying about speed and bypassing the HOA bureaucracy, but if I'm a seller, my instinct is still to maximize profit. The conventional wisdom is that selling on the retail market, putting it on the MLS, always nets you the most money. Giving up a potential 10% or 15% retail premium just to sell a house in 7 days to a cash buyer feels like leaving money on the table. Is the math actually on the seller's side to move that fast?
Well, this raises a really important question,
Huh.
and it requires separating our emotional attachment to the list price from objective financial analysis.
Okay, lay it on me.
The critical concept the source outlines here is holding costs.
The silent equity killers. Break down how those actually work.
Every single month, a property sits unsold on the market. It is actively consuming the seller's financial resources. It is a strict mathematical equation.
Like a slow leak.
Exactly. Let's say you have a property sitting for 90 days. You have to tally up 3 months of prorated property taxes, 3 months of homeowners insurance premiums, which in Florida are exorbitant.
Right.
You have utility minimums. You must keep the air conditioning running at all times so mold doesn't grow in the humidity like we talked about earlier.
Oh, wow.
You have ongoing HOA fees and routine lawn maintenance to maintain that curb appeal we discussed. And crucially, your monthly mortgage interest payments.
That adds up fast.
When you sit down and tally these holding costs month after month, you get a mathematically clear picture of the true cost of waiting for a retail buyer. Your net profit is your theoretical retail premium minus the ongoing compounding cost of time.
So what does this all mean? If the traditional market is full of this friction buyers getting denied by banks, HOAs holding up condo sales, holding costs, bleeding the seller dry, this specialized cash buying industry isn't just a convenient service.
No, not at all.
It's really a symptom of a broken, dangerously illiquid traditional housing market. How does their direct buyer process actually function?
It functions by aggregating capital to absorb the risk that normal retail buyers run away from. The direct buyer's business model is engineered to take the stressful burden of project management, contractor negotiation, and capital risk entirely off the seller's shoulders.
So if a house has those cast iron plumbing failures or a roof that's 10 years past its rated lifespan, the direct buyer just absorbs that liability.
Exactly.
And the economics of the as-is transaction are wild when you read the FAQ section of this article. The convenience factor is engineered to remove every possible barrier.
It's designed to be seamless.
Right. There is no cleaning required by the seller, no expensive staging costs to make it look nice for Zillow, no 6% real estate agent commissions eating into the equity.
You can just walk away.
You can literally leave behind unwanted heavy furniture, accumulated debris in the garage, or broken appliances. The text notes that the local crews handle all the cleanup, disposal, and structural repairs after the closing is completely finished and the seller has walked away with their funds.
What's fascinating here is how this alters the final net math for the seller.
How so?
Well, by completely bypassing traditional bank financing, by skipping those agonizing underwriter approvals, and by eliminating external property appraisals, the initial cash offer is evaluated on a totally different scale. Yes, the top-line cash offer might be lower than a theoretical retail asking price. However, it often represents a higher net retention of actual funds for the seller.
Because you aren't paying the hidden toll booths along the way.
Precisely. In a conventional retail sale, you have to deduct the agent commissions, the standard closing costs, the buyer concessions they demand for closing, and the mandatory repair credits you inevitably have to concede after the buyer's inspector finds a flaw.
Right, they always find something.
Add in those monthly holding costs we tallied up, and the retail premium vanishes rapidly. The rapid cash offer bypasses that attrition, often putting more deployable capital in the seller's pocket at the end of the day.
That is a huge paradigm shift.
Plus, they offer flexibility. Because these specialized buyers use private capital and don't rely on bank funding schedules, they allow sellers to choose a highly specific closing date that perfectly aligns with their own relocation schedule.
It's a completely different paradigm for liquidating an asset. It treats the house like a financial instrument rather than a precious heirloom.
which, in this environment, it essentially is.
So, to synthesize this deep dive, the Sarasota real estate market is a high-stakes ecosystem. You have severe, relentless environmental wear and tear from humidity, UV rays, and storms.
Yeah.
You have hyper-specific architectural demands dictating insurance premiums, and you have complex, draining financial holding costs.
That's a lot to manage.
All of this makes traditional retail property liquidation slow, bureaucratic, and highly risky if you don't possess a perfectly updated property. Direct cash buyers have essentially stepped in to provide a data-driven, rapid liquidity alternative that cuts right through that traditional friction.
It is an exit strategy engineered entirely for speed, certainty, and risk transference, prioritizing guaranteed capital over speculative retail pricing.
Yes, and for you listening, the big takeaway here is that evaluating an asset isn't just about looking at its theoretical retail price on a glossy flyer or a real estate app.
Not anymore.
It is about calculating the capital required to make that asset competitive in the current environment and then subtracting the relentless holding costs of time.
You know, if we connect this to the bigger picture, it leaves us with a rather profound question about the broader future of homeownership and liquidity.
Oh, where does this lead?
Think about the mechanics we just discussed. As extreme weather events continue to increase globally, and as the costs of raw building materials and local labor skyrocket everywhere,
Right, which we're seeing.
and as insurance premiums become increasingly prohibitive across the board, will the standard slow retail housing market eventually become simply too risky for everyday sellers across the entire country?
Wow. That is a staggering thought. The friction becomes too much for a normal family to bear.
Exactly. This raises an important question. Are specialized, rapid, as-is institutional buyers not just a niche solution for distressed properties in Florida, but the inevitable future of all real estate transactions?
That is wild.
As homes become more expensive to maintain and harder to insure, the need for instantaneous institutional liquidity might become the only viable way for the average person to unlock their equity.
That really makes you wonder if that traditional real estate bank vault we pictured at the start is gone for good,
It might be.
and whether we are all just watching the sand drop through the hourglass waiting for the market to catch up. Thanks for diving deep with us today.